Don't go broke without infinite banking, part 2. Hi, my name is Sunny.
And I'm Alex.
We are the founder of Bright Horizon Wealth. Don't forget to leave a like on our video and subscribe to our YouTube channel to get a video every Tuesday and Thursday. So today we are going to talk about how you can make money at a lower interest rate than you pay and still make money. I would like to share with you a real life story that happened to me in the summer of 1999. Just to get some sales experience, I went to sell cars at a Honda dealership because back then I loved Hondas. But before that, let me ask you a quick question. While shopping for a car, do you remember asking yourself this question? How do I pay for it? Should I pay cash or finance it? Sounds familiar? Now, what if I told you that apart from paying cash or getting a loan, there is a third alternative which benefits you, the buyer, the most? That alternative is called infinite banking, which we are going to talk about with some actual numbers and real life scenarios. Now, back to my story. Whenever a new customer comes in, the clever auto dealership manager, Steve, always found the easy way out for himself and put them into one of those two categories, either finance or cash. As for me, because I came out from a banking background, it did not make sense. So I asked myself, is there a better way than this? Then 12 years later, in the spring of 2011, I found a system populated by Mr. Nelson Nash called infinite banking, and that changed my outlook towards money and investment forever. If you want to learn more about it, please watch our on-demand masterclass which explains it thoroughly.
So, here's a real-life scenario. Let's pretend that you go to the bank to take out your $30,000, which you'd been saving for a while. At the bank, the manager comes and tells you, I have a better deal for you. Instead of taking the $30,000 out, why don't you leave it here and let it keep on making the 4% compounding interest? Instead, how about if I give you a loan for $30,000 at 4.5% for 60 months using your savings account as collateral? You liked the idea, signed the paperwork, and now your monthly payment is $559.29. We're going to calculate that for you so you can see how much principal and interest you pay. $559.29 for 60 months is $33,557.40. What that means is you are paying an additional $3,557.40 in interest. But if you don't touch your savings account, you will earn more money than what you paid in principal and interest. So in order for me to be correct, this number, when I calculate it, has to be greater than $33,557.40. When I apply the time frame, $30,000 at 4% for 60 months is $36,499.59. And I think you'd agree with me that $36,000 is greater than $33,000. The question is, how does this work? Let's see how it happened. Every month that you're paying $559.29, your principal amount is going down. The longer you pay, the smaller your balance will get. But what is the characteristic of your savings account? Your savings account is growing because it's making 4% compounding interest. And because the amount is increasing, you are earning interest on a larger balance. And this is exactly how you are able to earn more money at a lower interest rate than you pay because the loan is a decreasing balance. But the problem is that we never take the time to do the math. We just look at the interest rate and let them either overwhelm us or determine what our financial decision is going to be without doing the math. The reason why we don't know this information is because the banks know that we're not going to take the time to do the math and figure out what the figures are. Let's have some fun. Take out your smartphone and ask a question like, how much will my car payment be on a $30,000 loan for 5 years with 4.5% interest? You'll get the numbers right away. The one thing I didn't even touch on is that not only do you still have $36,000 in your possession, but you're still driving the car. How crazy is that? Is that not eye-opening? You have $36,000 in your possession and you are still driving around your car. How many times would you like to do this transaction? The average American buys 7 to 10 cars in their lifetime. Do you see the possibilities with infinite banking? Lastly, don't miss the most interesting part of this series called the 3-bucket strategy next week. And make sure you own your own financial future or someone else will.